Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. This is the second video on investment decisions. The last video I have explained you about the meaning of the term capital expenditure. What is the importance of capital expenditure? Capital expenditure process, what are the stages applied in capital budgeting evaluation. Next we have discussed about incremental cash flows, cash flow versus accounting profit. Then tax implication on capital budgeting proposals. Lastly, uncertainty in capital budgeting. These are the topics already I have covered in the first video on investment decision. Now, in this video, I am going to explain you about the evaluation techniques. There are different tools and techniques available with the finance manager to evaluate a capital budgeting proposal, whether to invest in capital project or not to invest. For taking that decision, number of tools and techniques are available. In examination, not only problems but also theory, they will ask you, what do you mean by capital budgeting? What is the importance of capital budgeting? What is incremental cash flow? And what is the importance of cash flow? And what are the different techniques like PBP? What is PBP? What is NPV? What is IRR? So these concepts a student must be perfect to write in theory also, apart from problems. So watch the video till the end, don't skip in between. If you have not watched the last video, I suggest you go to the playlist of my channel. Select the subject Financial Decision Making 2. Select the video of capital budgeting, investment decisions. Be perfect regarding the meaning concept. Now, before starting the explanation of evaluation techniques, take the screenshot of the points which I have written on the board, then I explain every point. Now, evaluation technique. A number of tools and techniques are available with the finance manager to take the decision to evaluate the capital budgeting proposal. Now, the methods of appraising capital expenditure proposal can be classified broadly into two categories. The first is traditional or unsophisticated methods, and the second one is modern, sophisticated or discounted cash flow technique. In this way, broadly we have divided into two categories. The first one, traditional methods or unsophisticated methods. Undiscounted methods are two. Payback period method, PBP, or average rate of return, ARR. These two methods are the traditional old methods, undiscounted methods. Now, modern methods. Modern methods are the sophisticated methods and discounted methods. And these methods are superior. So what are the different discounted methods? Net present value, NPV, it is in short form we call it. Then secondly, profitability index, PI. And lastly, internal rate of return, IRR. So totally 5 methods. The first 2 methods are traditional. The next 3 methods are modern. The first 2 methods are PBP, ARR. And the next 3 modern methods are NPV, PI and IRR. That's it. Now I'll explain one by one. In previous examination, they have asked you, what do you mean by payback period? So watch carefully here. The PBP stands for payback period, is defined as the number of years required for the proposal's cumulative cash flows to be equal to its cash outflow. Simple, very simple. The PBP is the time required, the period required in which the cumulative cash inflows will be equal to the cash outflows. First of all, a machine is purchased for, let it be 1 lakh. Every year we are getting the cash inflow. First year suppose 20,000, second year 30,000, third year 40,000, then 10,000. Like that every year we are getting the cash inflows. Now cumulate. Add up all the cash inflows. The cumulative cash inflows will be equal to cash outflow. So in how many years the cumulative cash inflow will be equal to cash outflow. That number of years is called payback period. In simple words, we can define, in other words, the payback period is the length of time required to recover the initial cost of the project. It's very easy. The definition is very clear. The time period or length of time required to get back our initial investment. How many years we require to get back our initial investment? That time period is called payback period. Simple example I'll give you. Suppose a machine cost rupees 1 lakh. 1 lakh rupees is the cost of the machine. This is the cash outflow. After purchasing the machine for 1 lakh, we are expecting 25,000 rupees every year return. Our cash inflow will be 25,000 in first year, second year, third year, fourth year. So how many years we require to recover our 1 lakh rupees? 4 years. First year 25,000, second year 25,000, third year 25,000, fourth year 25,000. Total 1 lakh. So total 1 lakh rupees cash inflow, 1 lakh rupees cash outflow. That means PBP is 4 years. Length of time is 4 years. That is called payback period. One more definition, it is the number of years required to recover our investment. How many years we require to get back our investment? That number of years is called PBP. Now, it is one of the most popular and widely recognized traditional methods of evaluating investment proposals. One of the most important traditional method, old method, which is widely used in evaluating the capital budgeting proposal is PBP. Then there are two ways of calculating the PBP. How to calculate the PBP? Two methods. The first method will be applied when the annual cash inflows are constant. The annual cash inflows are constant, then PBP will be calculated by this formula. Initial investment divided by constant annual cash inflow. Just now I have given one example. The cash outflow is 1 lakh and every year we are getting cash inflow 25,000. So 1 lakh divided by 25,000, you will get 4. So easily we have calculated the PBP by applying this formula. But this method will be applied only when annual cash inflows are constant. Suppose if annual cash inflows are not constant, example 1 lakh rupees cash outflow, first year we are going to get 30,000 cash inflow, second year we are going to get 20,000, third year we are going to get 40,000. So every year cash inflows are different, fluctuating. In that case we cannot apply the formula. In that case we'll apply cumulative method. In cumulative cash inflows, we find out in which year our cash outflow and cumulative cash inflow will be equal. That point will be clear by doing the problem. So these are the two methods of calculating the PBP. The PBP can be used as a decision criteria to accept or reject an investment proposal. So this technique of calculating PBP will be used to take the decision whether to accept the proposal or to reject it. How? Here, if compare the actual PBP with the predetermined PBP. Predetermined PBP means standard PBP which is given by the management. Suppose the business management says we will not accept any project whose PBP is more than 5 years. More than 5 years. So this 5-year PBP is given by the management. It is called predetermined or standard PBP. Now we calculate the actual PBP. Then compare the actual PBP with the standard PBP. Suppose the actual PBP of the project comes to 6 years, whereas standard PBP given by the management is 5 years. Reject it. Because management says don't accept any project whose PBP more than 5 years. If the project PBP is 4 years, accept the project. Like this decision can be taken regarding accept and reject. Then alternatively the payback can be used as a ranking method. If 2 or more than 2 projects are there, we have to select any one of the project. In that case we give the ranking. The lowest PBP, that project will be given first rank. Like that we give the other ranks. So whichever project has the lowest PBP, that will be given first rank. In this way ranking can be given. So I have explained you the meaning of the term PBP, and how to calculate the PBP and how to take the decision in PBP. Now, advantages. Just now we have discussed it is one of the most popular, widely traditional method of using. Why it is popular? Some advantages are there. The first one, very simple measure of economic feasibility. Even a layman can understand this method. Any person. That means how many years we require to get back our investment. So simple. So it is easily understandable. It is easy for measure of economic feasibility. Very easy to apply, calculate and interpret. The calculation is not at all tough. The calculations are very simple, easy to interpret. Then third one, it is easy to understand. Anybody can understand the meaning of the term PBP. These are the advantages. Now, what are the disadvantages of limitations of PBP? The first limitation fails to take into consideration the time value of money. That's why. This PBP is called undiscounted technique because it treats that there is no time value of money. The value of money will remain same today and future. No change in the value of money. But in reality, the value of money will change from time to time. Today's value of money is more than the value of money in future. Today the purchasing power of money is more than the purchasing power of money in future. The future, the value of money will come down due to inflation, due to number of factors. That's a fact. But this PBP method will treat that the value of money is same. Time value of money is not considered. That is the drawback, limitation. Next one is, it does not measure the profitability of the project. It will focus only on liquidity. It suggests that whichever project will return back our investment as early as possible, that is better. It is not concerned with the profitability. Profitability is ignored in PBP. Third limitation, it fails to consider the magnitude of cash flows. It considers only how many years it will take to get back our investment. The magnitude of return will not be considered. Example, one project will give more returns, more cash inflows in the beginning years and less cash inflow in later year. Another project will give less cash inflows in the beginning and more cash inflows at the end, later. It will treat both the projects as same. It will consider the total cash flows. It will not consider the magnitude. When we are getting how much, it is not bothered. The magnitude of cash flows are ignored. That is also one of the drawback. So these are the limitations due to which it is not the superior method of evaluating capital budgeting proposal. Now next comes second traditional method is average rate of return, ARR. The average rate of return, ARR, a method of evaluating capital expenditure, is also known as accounting rate of return. The name is average rate of return or accounting rate of return. Both mean same, ARR. Second method of evaluating capital budgeting proposal. It's an undiscounted method, traditional method. Now it is based on accounting information rather than cash flow. So many techniques are there. All the techniques will use cash flow. But this ARR is the only method which does not consider cash inflow. It will consider only accounting profit. But in the previous video, I have explained you that cash flow is superior to accounting profit. Accounting profit is not the right measure to evaluate the future benefits, whereas cash flow is superior. But unfortunately, ARR will consider accounting data, not the cash flow. Next, there is no unanimity regarding the definition of rate of return. Different formulas are there for calculating the rate of return. There is no unanimity. Then next one, there are a number of alternative methods of calculating ARR. The ARR may be defined as the annualized net income earned on the average funds invested in a project. The meaning of ARR is the percentage of annualized return over the average investment. What is the percentage of average profit on the average investment? Simply formula for ARR is average profit after tax. The average profit after tax divided by average investment into 100. This formula will give you ARR. So the ARR is found out by dividing the average after tax profit by the average investment. Just now I told you how to calculate the ARR. In numerator, take the average profit. Denominator, take the average investment into 100. A percentage you will get. Now, as a accept or reject criteria, this method will accept all those projects whose ARR is higher than the minimum rate established by the management. Just like the PBP, here also some standard ARR will be given by the management. The management says don't accept any project whose ARR is less than 20%. The minimum rate given by the management 20% ARR. Now we evaluate the proposal by calculating ARR. If the actual ARR happens to be 30%, we suggest the project should be accepted. Because management says minimum 20% ARR we need and we got 30%, so accept the project. Suppose if the actual ARR comes to 15%, whereas the standard ARR given by the management is 20%, that means the actual ARR is less than the standard ARR, reject the project. In this way, decision will be taken regarding accept or reject ARR. And sometimes alternatively, if different projects are there, we calculate ARR for every project. Whichever project is having highest ARR, that will be given rank 1. Below that will give rank 2. Below that will give rank 3. Like this, ranking can be given, right? This is called the ARR. Now, advantages. The advantages of ARR, simple to understand and use. It's not so difficult. The only thing is two things you require: average profit after tax and average investment. So easily you can calculate. Second, it places emphasis on the profitability of the project rather than liquidity. One more advantage is in PBP, it has not considered the profitability, it considered liquidity. Whereas in ARR, it considers the profitability. Then third one, it considers the entire stream of income over the entire life. Next advantage of ARR is, ARR considers the entire profit over the life of the project. Whereas in PBP, it will not consider all the cash inflows. It will consider the cash inflows up to the PBP level. After PBP level, the cash inflows are completely ignored in PBP. Whereas in ARR, it considers all the benefits throughout the entire life of the project. These are the advantages. Now, disadvantages, again, the same disadvantage what we have in PBP. The time value of money is not considered in ARR. That is the biggest drawback. In reality, there is time value of money. The value of money will change from time to time. But ARR says the value of money will not change. The value of money remains same. The first year value of money will be same as the 10th year value of money. In reality, it will not happen. Next, accounting profit is used rather than cash flow. One more drawback of this ARR is, it is using accounting profit, not cash flow. In the previous video, I have explained that cash flow is superior to accounting profit. Because accounting profit, number of ambiguities are there. Number of non-cash expenses are taken. So in that case, we cannot rely on accounting profit. It's cash flow. But here, accounting profit. Last one, it does not consider the differential timing of receipt of cash. It does not consider the magnitude of cash flows, magnitude of returns. It will consider that more return we get in the earlier years or more return we get in the later years does not make any difference. But in reality, the more returns if we get in earlier years, it is better than getting more returns in later. That means magnitude of returns are not considered in ARR. So I have explained you advantages and limitations. The two methods I have explained, that is undiscounted method, traditional method. The first method PBP I have explained, the second method ARR I have explained. Now I am coming to the modern methods. In modern methods, we have three methods: net present value NPV, and PI, profitability index, and internal rate of return IRR. These are called discounted techniques because time value of money is considered here. No time value is considered in this traditional methods. That's why it is called undiscounted. Here it is called discounted cash flow. The first very important discounted cash flow technique is NPV, net present value. The first discounted cash flow technique is NPV, net present value. NPV may be defined as a summation of present value. PV stands for present value of cash inflows. Cash inflows is also called as CFAT. CFAT, cash flow after tax. So again I repeat, NPV may be defined as a summation of the present value of cash inflows CFAT in each year minus the summation of PV of cash outflow. Simply remember the formula for NPV. NPV is equal to present value of cash inflows minus present value of cash outflows. Always while watching the video, keep a notebook, calculator, pen ready. Whenever I say something important, note it down. Then only you can be able to remember. Otherwise, you just forget it. So, the formula for NPV, present value of cash inflow minus present value of cash outflow. The decision rule for a project, if the NPV is positive, accept, and reject if it is negative. Very simple criteria. How to take the decision after calculating NPV? If NPV, net present value, is positive, accept the project. If NPV is negative, reject the project. If NPV is equal to 0, indifferent. Indifferent means whether accept or reject. In both cases, you are not going to get any benefit. No benefit. Where the cost and benefit both are equal. That is called indifferent. Now, on the basis of NPV, the various proposals would be ranked. Ranking can also be given. If number of projects are there, we calculate the NPV for each project. Whichever project will give highest NPV, that project will be given first rank. Now, advantages. What are the advantages of this NPV? Many advantages, because this is the superior, most superior method of evaluating capital budgeting proposals. The first one, it recognizes the time value of money. Remember, the biggest advantage of NPV is that it considers the time value of money. It considers that the value of money will change from year to year. That fact is considered. That is very important advantage. It uses the discount rate, which is the firm's cost of capital. For discounting the future cash inflows, we need the rate. Which is the rate? The cost of capital of the company. What is the cost of the capital of the company? That discount rate will be used for discounting the future cash inflows. It considers all cash inflows over the entire life of the project. Like PVP. PVP will consider only for the time period during which we recover the cash outflow. Recover the cash amount of cash outflow. But in case of this NPV, we consider all cash inflows during the entire life of the project. Fourth one, by accepting the project with the highest NPV, the profit will be maximized. Naturally, when we apply NPV, we suggest that project which gives the highest NPV. When we get the highest NPV, definitely the profitability will be the highest. We can increase the profitability. Last one, it is superior to other methods. If we compare NPV with all other methods, then NPV is the best method. Next, limitations. But remember, it does not have only advantages, it will suffer from some limitations. First limitation, it is difficult to calculate. It is not as easy as to calculate PBP or ARR. Little bit calculations are required, some practice is required. So comparatively, calculations are more in NPV. Second, it will not give correct answer when the payback period, when the project with different investments are compared. This method NPV is correct only when all the investment projects cost is equal. If you have different cost of investment for different projects, for example, A project required 10 lakh, B project required 15 lakh, C project required 20 lakh. In that case, we calculate the NPV. You may not get the correct answer. This will give the correct answer when the cash outflow will be same. The cost of the project should be same for every project. Third one, NPV method favors long-lived projects. Normally, NPV will be better when the project life is more. For short-lived projects, the NPV is not a good criteria. It assumes that intermediate cash flows are reinvested the firm's cost of capital, which is not always true. One of the assumptions in NPV is the intermediate cash inflows. The cash inflows which we receive during the life of the project, that cash inflow will be reinvested at the cost of capital, at the rate of cost of capital. But this may not be true. Whatever cash inflows we get during the entire life of the project, we may invest or we may not invest. Even if we invest, the rate of return may be different than the cost of capital. That is the reality. Next one, last one. It may mislead when dealing with alternative projects or limited funds under conditions of unequaled life. So this NPV will not be suitable when the life of the project is different, when the amount of project will be different, when the nature of projects are different. In these circumstances, we cannot apply NPV. NPV will be applied when all the projects' lives are same, when all the projects' investment cost is same, then only it can give the correct answer. Otherwise, it will mislead. That's all. So in this video, I have explained you about the techniques of evaluating the capital budgeting proposals. Traditional methods 2, PBP, ARR, and modern methods 3, NPV, IRR, and PI. So in the next video, I'll explain the remaining modern methods, that is PI method and IRR method. After that, we'll start the problems on these investment decisions. So if you're satisfied with my lecture, give a like to the video, share my channel, give your comments, subscribe if you have not yet subscribed to my channel, and buy the super thanks which is given below my video. Inshallah, we'll continue in the next video.